Okay. All right. Hi, everyone. We have Fabio Gulla here from NJ Lenders. I've had a lot of welcome. Thank you for taking this.
Thank you for having me.
No problem. I've had a lot of people asking me about the market and interest rates and forbearance, and I thought, who better than to have you
Thank
help
you.
answer, these questions that I'm getting from a lot of people. And, this is your specialty. So,
Sure.
yes. So just wanted to talk about how the government shutdown is affecting buyers and sellers right now and what the interest rates are looking like.
Okay. All great questions. Thank you. And I appreciate being here. I truly do. I think it's smart for you, one, to have these questions because, one hand in this particular situation directly affects the other.
Right.
When I in tandem trying to create and keep a market afloat. Very tough.
Mm-hmm.
Let's talk about the sexy one first, right? Let's talk about interest rates. Everybody wants to know where interest rates are. I mean, if I had literally half a penny for every time somebody called me up, wanted to know what rates were today, I'm a very rich man. And I'd share it with you, of course.
Right.
But being said, well, it's interesting because, especially in the Bergen County area where most of the applicants are, we'll say for the most part, more informed than not.
Mm-hmm.
People that are watching the market and they understand that the interest rates are tied to things like the 10-year treasury bond, mortgage-backed securities, and MSRs, which are the servicing on debt. And interesting, they've always been very correlated and connected. And as a result, you're able to kind of figure it out. Well, what we've learned and known over the last 20 years, let's just throw out the window right now. And that's been the problem because the connection there that kept us very sound and secure is gone. It's not there anymore. So you can look at the 10-year mortgage-backed securities and these MSRs, which are the servicers, and kind of not be able to figure out anymore where we're going. Very quickly, on the conventional side, interest rates are still at a 20-year low, and we've been kind of lucky because over the last 12 or so years, every time we make the bold statement, interest rates are the lowest they're ever going to get, and here they come again. Unfortunately, right now, interest rates are low simply because we've got this pandemic. So reality, the coronavirus has created this downward swirl into the interest rate market. For a lot of people, they want to catch lightning in a bottle, so to speak. Interest rates at the moment seem to have stabilized, like the traditional 30-year with good credit, 20% down, single-family residential. You were in the very low threes. On a good day, we're at 3.125-ish, okay, which are still outpacing most of the market. But there's been some influx, or there've been some issues on the FHA side. FHA, which was a catch-all, let's say, for all the other types of products, inferior credit, possibly some housing issues, some credit issues, down payment issues. That market has taken a little bit of a hit simply because it's a riskier market.
Right.
And when we're in these types of riskier times, riskier products have the greatest, to dare say, risk. So that being said, interest rates reflect that risk. So they've gone up. In fact, a lot of lenders or the secondary market have increased interest rates on the FHA side. So where FHA was a catch-all and had very interest rates, right now they're not as sympathetic as we'd like them to be. Okay. So depending on where your credit score is on the FHA side, conventional might actually be a little bit of a better product. So to answer that question very specifically, on the conventional side, yes, today interest rates are fantastic.
Okay.
The FHA side, depending on some contributory factors, down payment, maybe it's better than 3.5%, which is traditional on the FHA side. Maybe a credit score, we used to be able to go down as low as a 580.
Well, I was going to say credit score, they're wanting higher credit scores now, right?
They do. They went from 620 to 640. Now some people are entertaining nothing less than 680.
It depends on your lender, correct?
It does, but you know what? After 2008, the federal government came in, kind of consolidated our industry to make it very transparent. I say we all kind of fish from the same pond these days, okay? Plus or minus. Yeah, there's a lot of outside investors that are willing to take the risk. But I have a buddy of mine who's down in South Carolina right now, and if you want to do a loan par below 680 on a credit score FHA, that interest rate's 5.5%. So that's high
Yeah.
by standards. So you got to weigh it out. You pick your poison.
Right.
Now, on the other end, renovation loans right now are not very high on anyone's list. A lot of the lenders that were doing renovation loans, home style, FHA 203K, they've suspended financing because they're not willing to take on that risk at the moment. A lot of the other niche products, like for business owners, something called a bank statement program, which was pretty popular. Right now, not many people are offering that product at all.
Mm-hmm.
So what happens is, in times like this, you circle the wagons, the industry consolidates, tightens itself, only cherry picks from the products that they believe are going to perform,
Mm-hmm.
so they can have the liquidity to again then open up the markets. So very low, right? That's kind of what we start today. So depending on what you want to do, I still think interest rates are good.
Okay, perfect. Thank you. So how will the shutdown affect buyers when they go to try and take out a loan when they want to purchase a house, whether it's now or a month from now, 3 months from now?
Yeah, that's you say that.
Question.
The first thing that comes to my mind is no ticky, no shirty. One of the simplest guidelines on the book is that when at the time of application
Mm-hmm.
and when we close you, you have to be gainfully employed. So if you're in application right now and you lose your job or your job is furloughed at the moment, or your job is uncertain, you could be a day away from closing. Unfortunately, you're not going to close. Okay. So, we do have people in loan application right now that unfortunately you're just simply not going to close because you have to be gainfully employed.
And that was another one of my questions, like people that are, they're temporarily out of work, for this time period, and then, will go back to work. So they need to be working at that time.
Yeah, you will have to be working minimally. Safe bet is at least 30 days to see if there's a resume.
Right.
An hourly worker, for sure. Hourly workers sometimes get hit the longest because the underwriter wants to make sure that you went back to your 40 hours at your pay and that it's going to, be consistent moving forward.
Mm-hmm.
W2 wages, obviously, right now, most W2 wage earners are getting furloughed, but they're able to keep their pay. Okay. Well, then that doesn't mean furlough, but they're able to stay at home even if they're not working with pay. Don't know how much longer that's going to happen, but that's something we're going to look at. See, the whole thing in the mortgage industry is, we want to make sure that you have a job at closing. But the whole theory is, what is the probability of a continuance of your job? So that's why they beat up on business owners so much. And that's why, the 2-year rule is such a must.
Mm-hmm.
Not so much that you have the job today. What is the probability of you continuing to have this job for the next 3 years minimally, and the probability that your income is going to stay the same or increase? So realistically, to answer your question, they want to make sure you're at work. They want to make sure that you're at work where you left off. Mm-hmm. And the probability of it to continue will continue.
Right. Okay. And that makes sense. But I do feel like a lot of people are confused by that because in their mind, they still have a job and think that things can go as planned. And unfortunately,
I tell people all the time, because I get clients all the time, come on, Fabio, I've got great work history. I've been at the same job for 20 years. I've got great money. I've got assets in the bank. Correct. And it breaks my heart. But you got to look at it this way. Assuming you, Tara, were earning me $300,000, and you're going to write that check to me.
Mm-hmm.
So you're like, Fabio, absolutely, I have no problem. And then all of a sudden you realize I don't have a job. Are you still as confident to snap out that $300,000 check to me? And I feel Tara, don't worry, it's coming. If not this job, I'll find the next one. Now, all of a sudden, as an underwriter who needs to have a very conservative, risk-laden position, says, wait a minute. I don't know if I'm confident now writing you this check.
Right.
So it makes sense, though, when you think about it.
No, definitely. It really does. Definitely not worth the risk. All right. Thank you. Next. how are you handling appraisals? Like, how is the bank, are they going in? How is that all happening?
Here's once again, one man's pill is another man's poison.
Mm,
Now, appraisers are not going into the home, okay? Which
okay,
is, helps us out, right?
right,
On a purchase, most appraisers are simply doing a desktop, which means they're relying on the information from the MLS and all involved parties to
hmm,
give them what is considered to be good information.
right, okay,
On refinances,
hmm,
what's called drive-bys, okay?
hmm,
Just buy the house, not going in, making sure that the house still exists, okay?
right, okay,
On cash out refinances, you do have to go in, right? Because now, once again, it's a layer of risk. Purchase, we believe all parties involved. There's a realtor, she's got a license, she's got insurances, she's a brokerage firm.
right,
Hopefully, they're listing phantom houses. You know what I mean? And
right,
so you can buy a phantom house. That's the theory. So, all right, we'll do a desktop. Refinances, okay. No realtor involved. Let's drive by the house. Let's make sure it's there. Have the homeowner wave from the window. Hi, this is my house. That's the end.
yeah, okay,
There was this misconception that on some of the appraisals, the homeowner could take interior pictures, but that opens up the appraiser to too much liability. So we're not going to go that way.
okay,
So on cash outs, which are not, they're pretty, there's a lot of them at the moment because the interest rates are so low, you do have to get inside the house.
right, okay,
FHA, same thing, same way with FHA. So on the appraisal end, it's gotten a lot easier.
okay, all right, thank you.
You're welcome.
And lastly, mortgage forbearance.
Oh my.
What is your intel on that? I feel like a lot of people are very confused on just the whole process, thinking that, they're not putting off, they're putting their mortgage on hold for the time being, and then it goes to the back end of their loan,
Right.
and there's other people saying, it could be you owe 4 payments at the end of that 90 days. So maybe you can just, obviously, I know it depends on lenders, but give us a little intel with your company and what you know.
Excellent. That's a great question. Forbearance. Well, let's just say that confusion is the foundation for the day, okay? Because traditionally, forbearance simply means we're going to suspend payments. And if you know anything about my industry, banks and investors don't want to suspend payments on anything, okay? Credit card, no suspensions. Car payments, no suspensions, right?
Right.
So forbearance, very simply, the federal government comes down and says, okay, we're going to allow for the non-payment of mortgages over a predetermined period of time to help the people get back on their feet. The problem with that is that the forbearance is not truly ultimately in the lap of the investor in so much as it's in the lap of the servicer.
Okay.
Servicer is an entity that purchases your mortgage and will collect your principal, interest, taxes, and insurance paid then to the investor. So the investor pays the servicer, the servicer buys the right to receive the mortgage from the investor to make those payments to the investor. So the servicer pays, traditionally in most instances, the servicer pays for the right to do so. So for every mortgage they take, so if they take 100 mortgages, let's say from Wells Fargo, they're paying Wells Fargo $1,000 a mortgage for the right to service, which means their job is to collect the payments, make those payments, okay? They're on the hook for those payments. That's something most people don't understand about a servicer. But that's the risk they run, but they collect a small percentage, make that payment to the servicer, to the investor,
Okay.
the small payment. So that's how they get paid. So why, Fabio, why do I want to service? Because at the end of the day, there's a certain amount of that payment, that investment that I'm making back by the right to service. Forbearance then means that the servicer no longer gets paid by you, the applicant, right? Because I'm going into forbearance. The government says I don't have to make my mortgage payment for at least 3 months.
Okay.
But the servicer still needs to make those payments to the investor.
Okay.
Okay. So at the end of the day, the servicer is on the hook for those 3 payments, those 6 payments, depending on how long that forbearance is, back to the investor, unless the investor says to the Servicer, don't worry, you're forgiven. The reality is that most investors are never going to say to the servicer, stop collecting the money from me. You know what? Part of your responsibility was to collect that. You accepted the responsibility of non-payment as part of your job description. So the fact that the federal government is telling you you don't have to pay me, okay, I'm not telling you don't have to pay.
Sorry, my kids.
It's okay. So what happens in this particular situation is that it's not necessarily the investor that you need to speak to. It's your servicing company. You need to call the servicing company. That's okay. I get it. You need to call the servicing company. Do you want to handle that?
No, it's okay. My husband's taking them out.
Oh, got it. You need to call the servicing company. Ask them if, one, they'll even accept the forbearance, what the rules for their forbearances are,
Mm-hmm.
and three, how many months they'll allow you to go into forbearance. Because your servicer might say, at the time, we're not accepting forbearance. I don't care what the federal government says. We're still trying to figure out how to implement the forbearance.
Right.
So in the meantime, until you get the approval to do so, you need to make your mortgage payments. Why? If you don't make your mortgage payments, the credit reporting bureaus still haven't come on board and decided whether they're going to forgive you not paying your mortgage, meaning they still may report you as late on your credit report.
Mm-hmm.
Investor may still say, listen, you miss one 30-day payment on your mortgage, we can still put you into foreclosure. So the credit reporting bureaus, the servicer, and the investor all have to be on the same page for this.
Right.
Okay? And that language is still kind of being written. Okay? So even though it's out there on the high-end umbrella level,
And everyone's jumping on it.
yeah, it needs to trickle down into our pockets somehow. So what are we telling people? We're telling people make your mortgage payment until otherwise you are told very specifically that you don't have to. Okay? And now it's my turn. I apologize.
No.
So that's the first thing. Secondly, so they put you into forbearance. How are they going to handle this? Where are they going to handle the money? Money still has to come back. First of all, you're not going to be forgiven the money. That's the first thing. It's just not going to magically go away. So one of three things are going to happen. Let's assume it's a 3-month forbearance. In month 4, okay, they may ask you to make that month's payment plus the last 3.
Mm-hmm.
Or they may take those 3 months off, put it at the back end of your mortgage. But you say, all right, Fab, I can live with that. Or they may take that 4 months and say, all right, we're going to divide that over the next 12 months. So we're going to take whatever that payment is, divide it by 12, and we're going to sprinkle it in all payments that you make moving forward. So you really need to be able to make sure what the servicer says to you before you do anything.
Right.
But before you even do that, the servicer is going to require your hardship. They're going to need to know what your hardship is.
So they'll have to show proof.
You have to show proof of the hardship. They're just not going to say, you know what, Tara, you and your husband want to take a little extra money on vacation. Forget about paying the next 3 months. No, they're going to say, show me hardship. So how long does it prove that hardship? Is it an acceptable hardship? What's the probability of you going back to work? Therefore, it's not declared a total hardship. I mean, what if they said to you, you know what, Tara, show me your assets to make sure that you have no assets to pay this back? You know, technically, they could say to you, as they're creating the new language for this, if you've got $100,000 in the bank, I'm not going to let you not pay your mortgage. Dip into your 401k. So, they're kind of making this up as they go along. I wouldn't be so quick to not make your mortgage payment at the moment.
So pretty much your last resort. If you absolutely cannot pay it, then...
I'm sorry, you were lagging. Say again?
Oh, sorry. I said, so basically make it your last resort. If you absolutely cannot pay it, then...
Correct.
Resort to going into forbearance. Okay.
Well, be informed. Before you make anything, before you make a move that's as drastic as not paying your mortgage, you have to call your servicer and find out.
Right.
Just
ask questions.
call my servicer. Hey, Wells Fargo, Wells Fargo, believe it or not, used to be one of the biggest servicers in the country.
Mm-hmm.
Call them up. I understand they're taking phone calls anymore because they're just inundated with people calling.
Right.
And they don't have the manpower. So once again, it's a great tool that gets funneled down, but like all big government applications, right, the bureaucracy takes time. So I would be careful with the whole forbearance thing.
Okay. And that's been probably one of the biggest questions that I've received, just because people don't know. They just automatically think, oh, I can put my mortgage in forbearance and that's it.
All right.
It's good to know, telling them to call their lender and making sure you're asking all of these questions before getting into that bind and knowing at the end what the outcome is and what you need to do.
100%. 100%.
And also the other thing is if you're with taxes, right? Like if your property taxes are mixed in there. I know.
Right. Correct. That is such a great point because, your state and local government doesn't want to hear you're in forbearance.
Right.
They need to get paid. State and local government still needs to get paid. In fact, even on the mortgage side, sometimes you escrow, sometimes you don't escrow.
Right.
And within your right not to escrow. But the biggest reason why there's a push to escrow is because you make your principal and interest payment on time.
Right.
You happen to live in a municipality where you hate the tax collector. That's it. I hate the guy. I met him at a barbecue and I hate him. I'm never going to pay that man another dime again. They can still foreclose on you because they can foreclose on you because a tax lien supersedes your mortgage.
Mortgage, right.
So you have to be careful.
Okay. All right. Well, you were a wealth of knowledge for me. And
I'm sorry. I know it's.
No, why are you sorry? That was amazing. And I'm sorry, my children were creeping in.
That's okay.
Could you see my face?
Okay.
Trying to
You're like, get
on!
You know what? That's like me when my kids are fighting in the background and daddy's on the phone call. I mean, I must have the scowl of death on my face sometimes when I look.
Thank God we don't always have to do this, like videos. It's more on the phone because, if looks could kill.
Yeah, well, that's okay, Mama. Listen, these are
we're all
extreme.
learning and trying to figure this whole thing out, being home and still trying to make things work.
Yeah.
But, well, Fabio, thank you so much for answering my questions and taking the time to go over everything.
Tara, I thank you. And anything I can do to help you and your clients, please don't hesitate to let me know.
Awesome. Thank you so much. I appreciate it. And if anyone needs a lender, Fabio's your guy.
And if anybody needs a really good realtor who cares, that's why we're doing this, Tara's your girl.
Thank you. Thank you, Fabio. I appreciate that. I'll put Fabio's information in the bottom of my post so everyone can have your information, your number and email. All right.
Thanks, Tara. I appreciate that. Thank you.
You're welcome. All right. Everyone, have a good day.
All right, guys. I'll talk to you.